Hello and welcome to Asking for a Trend. I'm Julie Hyman in for Josh Lipton. And for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. Stocks rose on Monday, building on their comeback from a 4-week rout on Wall Street, brought on by President Donald Trump's chaotic tariff policy rollout and falling consumer confidence. We'll dive into the rest of the day's market trends. Then, CEOs are talking more about tariffs and less about a soft landing in 2025. We'll take a look at what companies are doing to prepare themselves for tariffs and how they expect the economy to perform for the rest of 2025. Plus, the Trump administration has quickly transformed the startup landscape. We'll take a look at the state of frontier tech and where the opportunities are now. Well, tariffs are dominating the discussion on earnings calls, but perhaps just as important is what isn't being mentioned on those calls, and that's a soft landing. For more on the trends we're seeing from CEOs, we're bringing in Eric Mukaya, founder of Mwango Capital and author at The Transcript. Eric, thank you for being here. So you monitor these calls really closely, and the trends have been really interesting here. I want to start with some of the tariff talk that we are hearing about, because I'm curious where the commentary is centering. I mean, I know that, I don't know if you've been counting the word uncertainty as well. I'm sure that's really high when it comes to what we're hearing about tariffs. So what are your takeaways?
Yeah, so thank you for having me. The key takeaway, I think, in earnings calls lately has been about uncertainty. So a lot of companies are highlighting that the level of uncertainty in the market is actually translating to their decision making. So they came into the year very optimistic about investing a little bit more, about putting a little bit more money into the market, about investing in the new year. But now what's top of mind is mostly uncertainty because of the tariffs. The tariffs are there one day, they're out the next day. So I think that's creating that level. They're not able to project how they want to invest. Some other companies are looking at it in the long term. They're looking at it as an issue that is going to be around for 4 years. And so they're not planning to change some of their plans. So I think some have said that they will pause a little bit to reflect. And most have said that they will take a longer term view. And I think that's top of mind in terms of most CEOs, what they're thinking so far in earnings calls.
And speaking of top of mind, we got a retail sales reading here in the U.S. for last month that was a little bit weaker than estimated. And I know that one of the other trends you were watching on calls was what CEOs were saying about the consumer. How concerned about weakness are those leaders?
So coming into the year, once again, CEOs were expecting a bit of a resilient consumer. On the margins, we are seeing a bit of weakness, and that has been reflected especially in airline commentary that was out last week. Delta Airlines was projecting around 8% growth coming into the new year, and now they are projecting a little bit of slowdown from 8% around 4%, and that comes to the domestic consumer. The domestic consumer is a little bit hesitant to book travel. I think just reflecting and seeing and waiting and seeing more is what has come into most of these consumers and businesses, so to speak. Earlier, I told you about how CEOs are on a wait-and-see mode to also see how tariffs impact them. So I think consumers are also anticipating, hey, some of the goods may actually go up in prices, so trying to preserve and conserve a bit of the cash that they have. So what you're seeing on the margins in terms of airline and retailers, they're saying in February and March, this hesitation from the consumer is being reflected in how they are spending. But overall, MasterCard, Affirm, they're saying consumer spending is stable. But I would say, once again, at the margins, the consumer is actually reflecting the concern and uncertainty that is in the economy.
Right, and you mentioned airlines. Of course, we got the big change from Southwest, which is now going to be charging bag fees. That had been sort of a hallmark. So that's perhaps a signal also. But to come back sort of to what you're saying here is that, and this is something we're hearing from strategists and investors also, is that even if things are going to slow, there still seems to be a level of confidence in the base, the fundamentals of the economy, even if things are sort of weakening on the margin. Is that how the CEOs are communicating as well?
Exactly. Also, so I think there is also a fundamental belief that the U.S. economy is strong. It can weather a little bit of this storm here and there. But then I guess the worry is that could this be pushed a bit too far to the extent that it actually weakens the fundamentals that are strong so far? I think that's where everybody's concerned. So you don't push things so hard that they break, but you can push it a little bit so that you can still get I mean, a market correction is okay. A correction in terms of spending, in terms of the consumer, that's okay, but don't push them a bit too hard. So that's what the CEO is saying. So overall, I think JP Morgan CEO, Diamond, and the Goldman Sachs CEO, both of them, I think one of the key comments I picked from them last week, they said that these levels of uncertainty may not be so good if pushed a little bit too far. So I think they have confidence generally about the state of the economy, but they're saying don't push things a little bit too far. So my takeaway is, hey, let's hope that things get resolved quickly, and the market welcomes a little bit the certainty that comes from policies that they can build on that are a bit more predictable, so to speak.
And Eric, just quickly, as someone who reads these conference calls very carefully over time, go back 1 year. What to you is the sort of biggest difference that stands out in these calls?
I think the biggest takeaway is that there's a heightened level of uncertainty in the market. So 1 year ago, nobody was worried about tariffs. Nobody was worried about countries. We are sure that the US and Canada were allies and all, the US and the European Union on one side. But I think now, a year later, people are a little bit unsettled. And I think that goes back to what happened in 2016, when this level of uncertainty happened in the markets and tariffs came up. What happened in most of the companies that I've noticed in earnings calls, they're saying that their supply chains are a little bit different from what they were 5, 6, 7 years ago. So I think they've shifted a bit of the base of manufacturing away from China and diversified their supply chains. I think that's what happens also. Some of this, the uncertainty, when it crops in, people start rethinking, hey, I had depended on my plant that is in Canada to be able to supply my goods to the US. But now going forward, maybe I may need to reflect about having a little bit of that plant, some of those goods be produced in the US. Right. So I think that's what the fundamentally is changing. So trust and uncertainty, trust is low and uncertainty is a little bit too high.
Yeah. Eric, thank you so much. Appreciate it.
Thank you.
Stocks closing the day higher. The S&P 500 rebounding for a second day after it entered a correction. Here with more in the trading day takeaways, Yahoo Finance's Jared Blickery. Jared, are you wearing any green on your person?
Right here.
Okay.
I try to please. And not only that, I brought a bevy of headlines that I think would be appropriate to the day, if not the name of a new podcast. Starting off with shamrocks and stocks here. Let's just take a look and think about the past Mondays, 3 in a row we've had down. And as you mentioned, we only entered correction, Julie, last week. And now in these 2 days that have intervened, suddenly we're off to the races. Well, I took a look at each of the days of the week, and this plots since the beginning of the year, how if you only invested on Monday, Tuesday, Wednesday, Thursday, or Friday, how it would have evolved. And so up top here, we have Wednesdays. Those have done the best, contributing net 23.51 SPY points. You multiply that by 10, you get the S&P 500 points. Tuesday, green, kind of middle of the pack. Same with Friday, although Fridays have picked up, especially since last Friday was a good day. And then it's really Mondays and Thursdays that have just turned down recently. So here's Monday, 1, 2, 3. And then we have Thursdays here also not doing that well. And it's nice that we were able to snap that streak today. How long does it last? I don't know, but this is a pretty marked direction and character. So I've been emphasizing over the last few weeks how we've needed a new playbook, and I think this is just telling things are different now.
Yeah, things definitely feel different now. So in keeping with the theme,
yes.
Talk to us about leverage, I believe.
We got luck of the leverage. Yes, naturally. So I was taking a look. I found this, and this is kind of wonky stuff here, but this is hedge fund net leverage score, and it's Z-scored in the white. So this is an oscillator. It goes up, it goes down. When it's going down, it's showing that funds are getting rid of positions. They're deleveraging, and so that is generally bullish for stocks because that means that they're capitulating. And so a lot of times, and in green, we do have the MSCI World Index. And a lot of these spikes down, like the one we have now, have been met with some surges in buying. It's not perfect, but it's just another indication that over the last week, I've said there are lots of little things saying that we should kind of turn around here. And it looks like we may have the beginning of this with this 2-day rally. I think it's a little bit early for celebration, but it looks like things should be turning around now.
And finally, what would a St. Paddy's Day chat be without a pot of gold?
Exactly. And we're talking digital gold, perhaps. So We did have gold hit, at least it closed at a record high today. I don't know if it was intraday, but it definitely settled at a record high. This is our year-to-date futures heat map here. Here is gold, so here's the current price, $3,010. Finally got there a few days ago. I think it was 3 days ago, above the 3,000 price. And let me just push the year-to-date on there, and you can see it's been a pretty steady climb up, a very low volatility. So gold has been a great place to be this year. You contrast that with what we've seen in Bitcoin and the digital gold, not quite as good. This is also a year-to-date heat map, but we'll just leave this on. Bitcoin down about 11%. The good news for Bitcoin is found its footing above the 200-day moving average. Hasn't breached that yet, so maybe a little ahead of the game because we saw the S&P take that out. We saw the NASDAQ take that out last week before the correction.
Is this like the rainbow and then maybe...
And there's a digital gold. See,
this is the rainbow indicator. Yes. I don't know if you're familiar with it.
No, this is brand new to me. So
it's brand new to me too. I just
someone called Pearson. We got to update the Bible of technical analysis here. All right.
Thanks so much.
Thank you.
Appreciate it, Jared. All right, up next, and to look at how policy uncertainty is weighing on emerging technology. We're asking for a trend on the other side. Well, in just a few months, the second Trump administration and its policy uncertainty has upended the deep and frontier tech landscapes, with some industries seeing a world of possibility. Other sectors, like climate, are in a world of hurt. For more on what the frontier tech landscape currently looks like, joining us now is Tom Biegala, Bison Ventures founding partner. Tom, we have seen, obviously, in the public markets, the uncertainty and what it has wrought. But there's also a lot of talk about capital markets, private markets, policy affecting things like subsidies and tax benefits. How is all that filtering through into the businesses and the technologies that you're looking at?
Yeah, it certainly depends on the sector that we're spending time in and the portfolio companies that are within those sectors. So you mentioned climate and sustainability. I think there's a lot of uncertainty both in the public markets as well as in the early stage ecosystem, especially for climate businesses that are reliant on either government subsidies, such as DOE loan guarantee programs or various forms of subsidies for electric vehicles, hydrogen, carbon capture, you name it. So some of those companies are facing a world of uncertainty. As we think about investing in sectors like that, first and foremost, we want to be backing companies that can stand on their own two legs and build big, successful businesses without that government regulatory support. But if you've built your climate business to be reliant on that, there's certainly a lot of uncertainty that you have to plan for and potentially alternative sources of capital as opposed to things like DOE loan guarantees, for example.
What is the pool of companies for whom the economics work without having that kind of government help? I mean, is it a growing number? Is it a shrinking number? Are there a lot of opportunities for you to choose from there?
Yeah, certainly. So there's some opportunities, for example, thinking about the AI boom, for example. That is a very energy intensive industry. It's only going to become more energy intensive as you think about climate businesses, for example. Serving that particular piece of the ecosystem is a place that you can certainly build a great business that is not necessarily reliant on government subsidies. When it comes to other sectors, there have already been some pressures. Take agriculture, for example. There's already been a whole bunch of inflationary pressures within that industry. Ignoring subsidies for a second and just talking about some of the things going on in immigration, you have a big labor pool that the U.S. agricultural system uses that consists of migrant workers. Without that labor pool, you have to move towards things like robotics and autonomy. And that certainly is a very interesting area of frontier tech that we're spending a lot of time in. If you don't have those low-cost labor resources to drive production, you need to turn towards things like those robotics and autonomy solutions in order to be able to do the labor that otherwise would have been done by things like migrants.
And obviously, you're not the only ones investing in this space, but is there enough private capital to sort of step up and invest in these sectors? And I would ask about climate in particular, because it feels as though there is a cultural shift away from some of those types of businesses, but I don't know if there is a capital shift that is following that.
Yeah, I think in any situation like this, the strongest companies will absolutely survive. The ones that have the best businesses, that are the most commercially mature, that have the strongest value propositions amongst their products, and already very good capital bases and investor bases at hand. I think businesses like that will certainly get through what is going to be a challenging period for the industry as a whole. So you're going to see some winners emerge out of that. But what I would say is that you're going to have a fair bit of companies that don't necessarily make it out the other end. And that's a natural part of the innovation ecosystem. You have a slew of companies that get funded at the early stage. Some of them make it to the growth stage, and even fewer make it to become successful big public companies. So that's a natural part of early stage venture capital investing. You do get that attrition rate. So I think this is going to be one of those times where really the proof is in the pudding for these companies, and the best ones will survive. The strongest ones will survive.
There is also in another sector in which you invest, sort of biotech and medical type of startups. There was a long tradition of many of those ideas being born in academia, right? And a lot of that academia, again, is supported by government grants and federal government grants specifically. So are you concerned at all about a decrease in that type of innovation because you don't have what has been those traditional homes for it?
Yeah, I think if this trend continues for an extended period of time, absolutely. I think if this is just a short-term disruption of government funding for some of these early stage research programs in academia, national labs, and elsewhere, then I think the industry can certainly weather that storm. But I think if you have a multi-year or even longer lack of government funding for some of these early stage innovations, then I think definitely you're going to see some impact. It's going to take a little time for that to work itself through the system, but ideally this is a short-term bump in the road and not a long-term trend.
And Tom, finally, as non-technically as you can, what's the opportunity that you guys are seeing that you're sort of most excited about right now?
Yeah, we're spending a lot of time in AI, but more physical world manifestations of it. So think robotics, think driving those next computing revolutions with novel technologies on the computer chip side of things, and even using AI to accelerate hardware development. So hardware development is a very time-intensive, human labor-intensive process. If you can use AI to get your designs right on the first try instead of building dozens, if not hundreds of prototypes, that's a big deal for various different industries. So those are some of the most exciting opportunities that we come across. And I think anytime you mentioned, biotech funding and climate and sustainability funding, I think anytime you see industries like that go through troughs in funding and a decline in investor interest, you can find some really interesting contrarian opportunities. So always keeping our eye out for contrarian bets in those sectors that sometimes spring up during these very challenging times, and many years in the future, they seem like no-brainers.
Yeah, cool stuff. Thank you, Tom. Appreciate it.
Awesome. Thanks a lot.
Coming up, we're getting you ready for a big week ahead. More Asking for a Trend on the other side. Time now for What to Watch Tuesday, March 18th. Starting off on the Fed, March's two-day FOMC meeting will be kicking off tomorrow. Wall Street largely anticipating the Fed will hold interest rates steady. Although last week's consumer price index report showed a little bit of cooling, inflation still remains more elevated than the Fed would like before it resumes cutting rates. Moving over to housing, monthly housing starts and building permits data for February coming out in the morning. Economists forecast starts will increase to an annual pace of 1.38 million compared to January, and building permits to take down to 1.45 million. On the earnings front, a couple of prominent Chinese companies reporting in the morning, with XPeng and Tencent Music. XPeng announcing reports for the fourth quarter. Analysts expect the Chinese EV maker will narrow its operating loss on the back of higher sales in the fourth quarter. And finally, we're gearing up for NVIDIA's GTC 2025. That's the GPU Technology Conference. Industry leaders coming together to talk about the future of tech, from AI to quantum computing. Yahoo Finance will be bringing you special coverage of that event, including CEO Jensen Huang's keynote address at 1 p.m. Eastern. Well, that'll do it for today's Asking for a Trend. Have a great night.